On Friday the 7th of June, if you hold one share of NVIDIA, you will end up with 10 after a stock split. And today we want to find out, is this a company we should continue to buy for some massive gains over the future? We can already see a strong buy rating from Wall Street, a buy from Seeking Alpha, a hold from Quant, and in fact this has been up nearly 190% over the last 12 months. So today we're going to do a deep dive into this company. We're going to take a look and see in their latest investor presentation how strong this company is. We're also going to take a look at some of their numbers, which are incredible, not just year on year, but also on the quarter, with some very sharp rapid growth to nearly every single income stream. We'll also remind ourselves of how well they performed in that latest earnings just last week, and we'll talk about the dividend safety. Now they have had a recent dividend increase, 150%, but more importantly for this company, we're going to take a look at their underlying metrics to see how rapid their growth is, not just on their sales but also their free cash flow, looking at their ROIC, some very important numbers that maybe you wouldn't typically look at. And we also want to see, what are insiders doing? Do they continue to sell? Have they been buying over the more recent quarters? And look at the same movement but with institutions, whether or not we see any themes with both insiders as well as those who are the big corporation. Now we're also going to do a very brief look at their top line revenue growth as well as their bottom line net income for a quick recap. And we also want to draw your attention to how strong this company is. Their balance sheet is phenomenal, some very strong numbers here. And ultimately we want to run this company into the valuation model, getting to our intrinsic value. We want to find our acceptable buy price given our investor margin of safety, and also see, do Wall Street see a lot of upside over the next 12 months? Now ultimately we're going to take a focused look on the discounted cash flow model. We're going to look at 3 different rates moving forwards, a low, medium and high, so you can also see where these numbers are coming from in the future and whether or not you agree, and maybe you want to look at some numbers to see what you believe the real intrinsic value of NVIDIA to be over the longer term. So let's jump into their earnings for a quick recap for those that did miss it. And we can see that their shares at the time passed over $1,000. Major reason for this being the AI driven sales, and we can see it does suggest that the demand for the AI chips that NVIDIA does make continues to remain strong year on year as well as quarter on quarter. And on top of that, their new AI chip called Blackwell will be helping continue that increase to their top line from essentially the next quarter as well as later on in the year. So very bullish, not just over their results as we're about to see, but also the forward expectations. We continue to anticipate some very large growth to all of their numbers. Now how they performed, well, they returned 612 on EPS, analysts targeting 559, so they absolutely smashed that through the roof. In terms of their top line revenue, 26 billion, a lot better than, as we can see, the market had anticipated, around 24.65. And in terms of their net income for the quarter, what we can see here, around 598 per share. When you do take a look at that same quarter last year, 82 cents. So we're seeing a lot of improvement for this company, not just on the headlines, but also their bottom line net income as well. Now, one thing that maybe did go under the radar for those that are following this company is that they did do a massive buyback, 7.7 billion worth of its shares. And as we can see, they do also pay a large amount as dividends, granted though that the yield is very small. And as we mentioned, a 150% increase to their dividend, ultimately going from around 4 cents per share to around 10 cents on a pre-split basis. So lots of growth. Now for those that want to see it a bit more detail, what we can see here are the income streams. Quarter on quarter, one thing that you should note is that the data centers has been exploding from Q1 FY25. If you want to look at that same quarter, we can see here up more than 4 times, 4.3 billion to 22.6 billion. And if you just want to look in the more recent quarter, we can see 18.4 to 22.6. So in fact, not just on the data center, we do see growth among other essential income streams as well, but that is where it is largely being driven. And as we can see, the total revenue quarter on quarter is increasing at a very rapid rate. And we also want to understand, is this going to continue into the future, or are we anticipating to see some kind of slowdown? Now, just a quick reminder with this company, over the last year, up 190%. Year to date, also very strong, significantly outperforming the S&P 500. And if you've been a shareholder over the last 10 years, this probably is one of the best in your portfolio, up over 24,000%. Now, in terms of a forward P, it is fairly pricey, 40.62. For those that want to compare it to the S&P, it is around 22, 22.5. But as always, we do need to understand whether or not this is warranted and justified, and if this is one we should really consider adding into our portfolio moving forwards. Now, one thing that we also like to look at is insider movement. Now, it does sit around 4.23%. We do notice 8 instances of insider selling, $332 million worth. And in fact, we just need to look at the more recent quarter, Q2 of 2024, $53 million. We also see pretty much sales nearly every single quarter over the last few years. And when we take a look to see who these insiders are, well, in fact, we can see just yesterday, the 30th of May, or a few days ago, the director, Mark Stevens, did sell nearly 10,000 shares worth for a very, very large sum, as we can see, 11.2 million. Whether or not you believe this is a bearish signal, you can incorporate that into your own investment thesis, but we can see pretty much every month that insiders have been selling. Now, if you want to go as far back, you can see, in fact, even on the 25th of March, we also see some selling. Incorporate this into your investment thesis or not, the information is there, so you can note that. In terms of institutions, well, 65% institutional ownership, 85 billion worth of sales, so quite a large amount over the last 12 months, but we see a lot more buying, 669 billion during the same period. However, what we do note here is that there has been a lot more sales in Q1 than buys, so it's just something to bear in mind. Over the longer term, over the last 12 months, in fact, more buying than selling by the institutions. However, in quarter one, the most recent quarter for the data set, we can see institutions have been selling more shares than buying. And we also, from the previous slide, did see that also insiders have been selling a lot. As always though, do your own due diligence. Don't just copy what these insiders or institutions do, but the information is there so you can take note. Now, one thing that we do want to have a very quick look at is to show their top line revenue growth really has been increasing, 4.7 billion in 2015. Their latest annual accounts from Jan 24, 61 billion. And we can in fact see over the longer term it has been increasing, but really over the more recent period do we see the large increase. In fact, January 2020 to 2023, it does look to be fairly flat. Something to understand that the data center increases has really propelled their top line, and it is something that we do anticipate to continue to increase over the next few years. In terms of their bottom line, as we can see here, 631 million in 2015. Nearly 30 billion, so an absolutely astronomical increase. And as we just said, we have only really seen this large increase over the last year in all reality. So something just to incorporate when we do continue to talk about this company. And in terms of the market size, because when we take a look essentially at the market cap moving forwards, we do anticipate AI from this Bloomberg article to be a 1.3 trillion market by 2032. And what this means is a compounded annual growth rate of 42% over the next 10 years. So it could be something really, really large to focus on for NVIDIA, where we may see that data center increase come for a lot more years, not just over the more recent period. When we take a look at the health of the company, well, total cash versus total debt, 4.6 billion in January 2015, 31 billion in their latest quarterly report. They do have a significant amount of cash, and as we can clearly see, over the larger period, it has been increasing. So that is 31.4. In isolation, it doesn't mean anything, but when we do compare it numerically and directionally to their total debt, what we can see here, whilst it has also been increasing from 1.4 billion to just under 11 billion, their cash is far greater, making their balance sheet very strong. It wouldn't even take them one day to pay off all of that debt net of cash on hand. And we can just see here graphically as well for transparency that it has been increasing over the last 10 years. Now, a few things that we do want to incorporate into our analysis is looking at their earnings data. And what we can see here, their track record over the last 4 quarters, they have beaten analyst targets by quite some distance as well. Just the more recent one, 54 cents, so a 100% track record. And look, it isn't expected to slow. The next quarter, year-on-year comparison, 135% is what the market is anticipating. And even over the next 3 subsequent quarters, still strong double-digit growth to their EPS on a year-on-year basis. If you want to have a look, if they do reach their target for January 2026 on the EPS, then a forward P will be around 31.25. But again, it does really come down to whether or not you do believe a company of NVIDIA's quality quality, and the backlog they have does justify this really rich essential valuation. But again, every investor will come to their own analysis and conclusion. So let's take a look at a few valuation metrics and grades before we jump into their investor presentation. In terms of evaluation, they get an F. Reason for this? Well, on a P non-GAAP basis, 40.62. When you compare it to the sector median, 23.54. So they are trading at a premium of just under 73%. But bear in mind that when we do look at other metrics, you will see that it could be warranted when we look at the growth and profitability. If you want to look at other valuation methods, in reality, we do see very poor in comparison to others in the sector median. But again, do note that the sector may not have a lot of high quality companies like NVIDIA, as we're about to look at. First one, growth grade. Well, look, in terms of the sector, with NVIDIA, 208% increase to the year-on-year increase. Their sector median at 3.08%. So obviously you can see that you wouldn't value a company like NVIDIA with those on the sector median, given the comparison on these numbers. Revenue forward looking, well, under 80%, the sector at 6.5%, and a few others that we want to draw your attention to, like the earnings per share, 38% expected increase year on year over the next 3 to 5 years. The sector median 13.81. So we can already see there is a lot of quality with this company, and there are a few other metrics here that if you want to take note. So just something to bear in mind. We're not saying that NVIDIA is warranted with the essential P that it trades for, but as we can see, it is significantly better than the sector median in a lot of these different metrics. Now finally, the profitability grade, they have an A+, no surprises here. Their gross profit margin 75% with the sector median at just under 50%. Bottom line, incredible, 53.4%, sector median at 2.59. And when we also take a look at their cash from operations, just under 41 billion, with others in the sector 92.94. Now, in conclusion, for this part of our analysis, we have one buy rating from Seeking Alpha, a strong buy from Wall Street, a hold from Quant, and we notice an F on valuation, A+ on both growth and profitability. Now, very quickly, for those that are interested to see how they've performed against others in the industry, in the semiconductors, we have Taiwan Semiconductor, a very strong one, as well as Broadcom, Advanced Micro Devices, and a few others that we have also covered on the channel. So NVIDIA over the last year, no surprises, up 190%. When we expanded over the last 5 years, absolutely none other that comes close, and the same can be said for over the last 10 years, 24,105%. So now let's jump into the essential company overview. Let's get into all of the details about this company, how strongly they've performed. And just before we do that, we want to let you know we have released our latest free weekly article. We've run through the best recession-proof stocks to own in your portfolio. If you want to gain access to this or any others, all completely free, do click on that pinned comment below. For example, if you want to understand the website's resources we use to identify undervalued stocks, or if you want to consider 20 undervalued dividend stocks for the portfolio, do click on the pinned comment below. It is completely free. So the first slide that we do want to take a look at, we'll just run through these at a quicker pace, is the fact that a lot of these products that they produce are getting a lot stronger year on year. In fact, 1,000 times of AI compute in 8 years. So now we understand why a lot of these products are in development, and essentially why a lot of companies are buying these from NVIDIA. In fact, their new one, as we said, to be released not too long, will also have a massive impact on their top line. In terms of how essentially these are going to impact the different sectors, as we can see a huge return on investment from AI in terms of a new investment cycle. We can see lots of different areas here. For example, it says that Copilot specialize for fields such as software development, legal services, education, and they can, this is the key thing here, boost productivity by as much as 50%. One of the reasons that essentially customers or clients do come and buy these products from NVIDIA, as they want to see monetization, productivity, all of these different areas improve in their business. And as we can see here, just a few different areas where they do believe that this will really help these companies and why they are warranted these high prices for their product. The next one that we want to point out here is the high ROI from the performance of their products as well. What they say here is a $1 upfront investment in NVIDIA will essentially translate to $5 in revenue over 4 years. And that is again why essentially customers are coming to NVIDIA, buying their products, as we can see here. There are always reasons. If you want to buy a product or service, you're doing it for many reasons. One of them, as we can see here, is for their increase into revenue in the own businesses of those clients. Again, very quickly to look at the clients that they have here, we can see lots of large ones that I'm sure you have heard of. Just something to see. If you want to pause and take a deeper look, you can. Now getting into the numbers. Now this is what I really like to see. Not only a top line increase over the longer term, as we can see here, but also the key thing here are the margins. In FY20, their margin was 34%. This is the operating margin. In FY24, 61%. So that is the last full year. Year to date, now we have just had one quarter, 69%. So what you're getting with NVIDIA is not just a top line increase in revenue, but also a margin increase, which is really going to help with their bottom line. It's going to help with the dividend increase. It's going to help with the share repurchase, returning a lot of excess cash one way or another to those shareholders, as well as the share price increase. Now what we can depict from here is that in the same quarter in FY25, their data center revenue, 87%. Look at that jump from the same quarter in FY22, 36%. So this is where the real growth driver is coming from NVIDIA. And as we looked earlier, the essential market cap of AI in general is expected to increase at a very large CAGR over the next 10 years. We then take a look at their gross margins, again just highlighting what we did talk about earlier. As we can see, over the longer term, this is now the gross profit, not the operating profit, 63% to 79%. So lots of positive news to take from this. And again, talking about the efficiencies, two of their nodes, as we can see here, cost $400K, and what this can replace are servers that cost around $10 million, as we can see, for the same workload. So they're getting a lot better, a lot more efficient, and that is why with all these new chips that they do come out with, the backlog is very, very significant. Free cash flow, something else that we'd love to talk about. We'll cover that when we do look at the analytics, the metrics. $4.3 billion in FY20, $26.9 billion in FY24, and just year to date, where we just have had one quarter, $14.9 billion. So absolutely insane. It will be interesting to see how much higher FY25 is than FY24. And again, the different ways that they use their capital, we can see here $9.5 billion of share repurchase. They still have a massive amount of authorization left as of Q1, 14.5 to be exact. The dividend, which they have increased, they have said plan to maintain here, but as we did see earlier, a 150% increase, and also other ways that they are using these investments. The other thing just to very quickly point out is specifically looking at the data center growth. It has been increasing consistently year on year, although we saw a massive rise in the last full year. Interesting to note again how much of an increase the full year of FY25 will be in comparison to FY24. Remember that Blackwell is also to be released as well. Finally then, on the investor presentation deck, we can clearly see here that the long-term essential market opportunity continues to increase. $300 billion just purely on data centers. We have $100 billion on the gaming, as well as a few others that we can see here. So lots to like with this company. And now we want to get essentially into looking at the details, the numbers, before jumping into the valuation. So dividend safety, if anyone was interested, 89, it is very safe. The market cap, 2.7 trillion, is a mega cap company. And even after the increase, the yield does sit around 0.04%. Now what we can see, again, no surprises here. Their dividend safety score has been reaffirmed. A dividend cut is highly unlikely. No surprises there. In terms of the key metrics from the last recession, well, no dividend was paid, so no comparative data. Recession sales, negative 35%. Remember, that is below the average of the S&P, which was negative 12. And they did, in fact, during the last recession, significantly trail, negative 78%, with the S&P negative 55. Now, dividend growth over the last 5 years, 1% increase year on year. Over the last 10, 8%. But as we said, that humongous dividend increase, 150% just last month. Now, if you are interested, this will now be 1 year of an increase and 11 years of paying a dividend without a reduction. Now, typically on the channel, we do look at dividend yield theory to identify undervalued companies. It states a company is undervalued when the current yield sits above the 5-year average. Given the yield is very low, not something that we are taking a look at, but interesting to note on a forward P basis, it does sit marginally lower than their 5-year average, but it does sit considerably higher than the sector as a whole at 24.7. Now, not much to say on the free cash flow other than whilst we want to see below 50%, it is only at 1% in FY24, 2% anticipated over the next full year. No worries at all with that, and we should expect them to continue to increase those dividends at a very rapid rate. In terms of free cash flow, well, we can see the massive growth rate over the long term. As always, we want to see consistent increases over the long period. We see a massive jump in 23-24, anticipated to continue to increase into 2025, and we do expect this to be hit by the company with all of the stuff that we have talked about throughout this episode. In terms of the sales growth, well, this is just the percentage format of what we've seen on a trailing 12-month basis, 208%. over the last full year, 126. Absolutely phenomenal. If they continue this, then this honestly could be one of the best companies for the future for those massive gains in the portfolio. In terms of total sales, well, we did cover this, so this is just another format to look at. In terms of shares outstanding, as always, then we want to see companies buy those share backs, return excess cash to our pockets. Now, over the longer term, two things to say. One, they would have diluted your position, a net dilution, but you wouldn't really care due to the fact that the share price has been up astronomical. But what we do note over the more recent periods from 2022, they have started to do share buybacks, as mentioned in the investor presentation, and they will continue to do that over the more recent years. In terms of ROIC, one of the most important metrics for me, I want to see 10% or more, just to give me faith that management are able to effectively allocate their capital. And we can see not only above the 12 for the semiconductor industry specific, but significantly better just the last year, 61%, trailing 12 months, 79%, absolutely insane. Now, in terms of the margins, nothing really to say here as we have covered them both, but operating, absolutely incredible because we have noted operational efficiency. It has increased over the longer term. In terms of the free cash flow margin as well, significantly above that 5% minimum, 45 in 24, 50% on a trailing 12-month basis. Lots to love about this company. And if there was anything else to say, well, the net debt to EBITDA, which is the earnings before the interest, tax, depreciation, amortization, correlates to dividend safety, balance sheet strength, below 1.5, and these are always the number of years it would take the company to pay off all of their debt net of cash on hand. 0, 0, 0, 0. Literally, it won't even take them one day to pay off all of their debt net of cash on hand for the last 10 years and into 2025. So absolutely phenomenal. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, what we're looking at here is the free cash flow year on year. Absolutely insane growth rate, just under 95%. Now, we're looking at three different growth rates, a low, medium, and high. We're going to start off with a low of 20%. And based on this, with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see an overvaluation signal with an intrinsic value near $720. So what this effectively means, if you believe over the foreseeable future they will increase that free cash flow by 20%, then there is implied downside to the current trading price of 34%. If you believe that actually that is way too low for this company that is performing incredibly well, at 25%, it would be an intrinsic value of just over $1,000. And as we can see here, around 8% downside to the current trading price. If you believe still that is way too conservative at 30%, you see an intrinsic value of just under $1,400. And this here gives implied upside of 27%. Now with these numbers, you can click on the pinned comment below, grab a copy of this valuation model, run your own numbers through to get your own intrinsic value, whether that's for NVIDIA, others in your watch list or in your portfolio. But what we can see here is for them to really warrant the current trading price, it needs to be increasing by over 25% over the foreseeable future. And that is subjective as to whether or not you believe they can maintain these very high numbers that they have done over the longer term. Now in today's episode, we will go for the medium target rate of around 25%. And this effectively means, as we're about to see now in terms of the intrinsic value, that essentially is just the DCF model, as that is what we have used today, and it comes to just over $1,000. Now, the current price at $1,096 does imply that it is trading right now above its intrinsic value, so effectively at a premium. Now, typically on the channel, we would use a margin of safety of 10%. We would allocate and execute on companies if it met our 3 golden criteria. That would mean they would have to have a wide moat, strong financial metrics, and good forward-looking data, all of which you could argue for NVIDIA. So if you believe that, it would be a buy around $906. But again, a lot of people may be happy with a 5% margin of safety, or in fact, some people may be happy to buy it at its intrinsic value, or even at a premium, given the quality of this company and the forward-looking data. As always, though, when we do take a look at Wall Street, we can see in today's episode, they are targeting around $1,200. They do see upside around 9%, and as we saw earlier, they do consider this a very strong buy. It does have a lot of positives in all of those 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. So I'd be interested to hear what price you think this is a buy, whether or not, in fact, with the stock split you are looking to add for some very nice gains in the future. Maybe it's on your watch list, or maybe for whatever reason, this isn't a company you are looking at buying today. As always, though, let us know your thoughts in the comments below. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and And as always, we'll see you all on the next one.